Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
CPI coming in below expectations. Traders adding to bets for 2 more rate cuts this year, including one next Wednesday. David Kelly of JPMorgan Asset Management joins us now for more. David, let's start with the inflation data. Is 3 the new 2? And is it going to stop this Federal Reserve from cutting interest rates?
Well, I think the Fed's going to keep on cutting rates. It's generally a better than expected report, but I think what it really shows is we have a K-shaped economy, and it's sort of a K-shaped CPI report. The thing that really jumped out at me is, first of all, rental costs coming down. There's, we've got a big change in demographics here, and rental inflation is just going away. You also saw used vehicle prices fall. I thought that was pretty interesting. And then the big thing here is core goods prices outside of food and energy. That's the stuff that should be hit by tariffs. But that's only up 0.2%, up 1.5% year over year. It is clear that mainstream retailers don't believe they can pass on the tariff increases right now. And that's what's making this inflation rate a little bit tamer than people feared.
David, doesn't this just justify what the market's already sussed out, which is that inflation fears were overblown earlier this year? The Fed can keep cutting, potentially below 3% by the end of next year, and that it's not going to cause a huge inflation problem?
Well, I never thought we had a long-term inflation problem, but I think it is still early days on the tariff effects. What's going to happen is, right now, retailers feel like they can't pass on the price increases. But early next year, you're going to have this refund bonanza. The average income tax refund per household, we believe, is going to be over $4,000. Last year was $3,200. And that is the exact time when retailers are going to feel like they can pass on these tariff increases. So I do think we've got a little bit of a spurt in tariff inflation still to come. But then, if nothing else happens, there isn't a lot of momentum in this economy, and it'll slow down again and it'll cool down again. So I don't think we've got a long-term inflation problem. My real question is, given how bubbly financial markets are, do you really need the Federal Reserve adding more liquidity to the party right now, or should they just hang on in there and say this is enough liquidity?
What are you saying, or what are you seeing that really is bubbly, given the fact that earnings have exceeded expectations, the forecasts have exceeded expectations, and we're likely to see more of the same next week with the tech earnings?
Well, valuations are extremely high for the over. Now, obviously, a lot of it's concentrated in the mega cap stocks, but also profits as a share of GDP are extraordinarily high. So overall, the total value of all U.S. market cap is about 365% of GDP right now. It was about 212% before the tech bubble burst back in 2000. It was 87% before the 87 stock market crash. So there's it's leverage upon leverage. High PE ratios on a very high level of earnings relative to GDP. Now, I still think this is a very good economy for equities, but I wouldn't say that you could call the market depressed at this stage. I think that one of the dangers here is that everybody gets out over their skis, and then you have a significant market correction or a bear market.
So are you talking about potentially, if the Fed is cutting into strength, they'll be making an error this month?
Yeah, because it's a different economy, and we keep on talking about, the Fed's going to tighten to lower inflation. Forget about it. The Federal Reserve's short-term interest rates are not impacting growth. They're not impacting inflation, but they are impacting financial markets. And the big problem that we've had in this century of the 2000s hasn't been CPI inflation getting out of hand. It's asset bubbles, whether it's housing bubbles or tech bubbles. And the Federal Reserve should not be in the business of blowing up bubbles. So I think they should, just take it easy. I don't mind if they cut rates a little bit here, but I certainly would have a problem if they cut rates below what they think neutral is, if the economy is not threatened by recession, because we are seeing money go into financial markets, go into financial assets, and just not come out. And it's kind of like a stuck valve. And the more money goes in, the more this market just seems to accelerate upon itself.
And David, we asked Governor Waller this question when he was on the programme last week. We asked whether he was getting lulled into cutting interest rates and potentially juicing financial markets. David, do you think there's a problem with their interpretation of the dual mandate, or just the dual mandate?
I think the dual mandate itself. I think that Congress needs to recognize, they need to recognize that monetary policy has significant impacts on financial conditions, and therefore maintaining stable financial conditions should be part of the goal. It's kind of like with the ECB, who for years decided they weren't supposed to intervene if one particular country got into significant economic distress and destabilize the euro system. And then finally Mario Draghi said, look, if Greece is a problem, we got to do something about Greece. Well, this is a similar situation where the mandate needs to be expanded a little to recognize the impact of Fed policy on financial and other asset price bubbles, to try to prevent bubbles or busts, because of course that's what a bubble creates a bust, and you want to have financial market stability, not just economic stability, and I think the Federal Reserve can have an impact on that.
Stay with us. More Bloomberg surveillance coming up after this. A downside surprise on headline and core CPI, unlocking some lower bond yields this morning, going into that Federal Reserve decision next Wednesday. Joining us now to discuss is Tiffany Wilding of PIMCO. Tiffany, welcome to the programme. Is this a source of comfort for this Federal Reserve next week?
Well, I don't know. I think certainly it's good news on the inflationary pressures, but the argument that we've been making, which I think is symptomatic of this report, is that the economic adjustment that we're seeing to tariffs is coming through less on a price adjustment, and instead companies are finding ways to defend margins by offsetting other costs. And I think the fact that you saw another headline this morning around a large retailer, that is doing, some layoffs at the kind of higher executive levels, that's just in our minds symptomatic of that they are finding these other ways to cut costs. So what that means for the Federal Reserve is that there is some downside risk to the labor market here. So I don't know that they should be completely taking a sigh of relief here. We need to see the labor market data obviously when the government reopens. But as you and Mike mentioned, we do think they cut in October. And of course the median expectation from the Fed is that they'll cut again in December.
How much of a forward look can they give us at the October meeting, Tiffany? When Chairman Powell goes into the news conference, he doesn't have much visibility on anything right now. How much guidance can he offer us for December and beyond?
Yeah, I think it's incredibly tricky, and I'm not sure that they will offer a lot of guidance. I think they're going to say that we don't have a lot of data to go on here. There's private sources of data, but even there, it appears that some of the Fed's, the previous sources of private data that they got in the labor market, maybe they're not getting anymore. So it is a much more tricky situation for the Fed. They're going to be looking at markets and and I think the news flow in order to kind of figure out what's going on here. And I think it's going to be really tough for him in terms of guiding any further.
Tiffany, a lot of people have been looking at the housing market in particular as a sign of disinflation going forward. And one thing that Mike pointed to was owner's equivalent rent. Looking at this, it just looks like inflation in owner's equivalent rent has fallen to the lowest pace going back to 2021 with a pretty big decline, which is one thing that's giving fuel to some of the enthusiasm in bond markets this morning. I'm just wondering how big of a tell that is for you.
Yeah, no, I think that the normalization in housing and rents is something that the economics community has expected for some time, and I would argue that it's delayed, and it was delayed because we saw a really big immigration boom over the last couple of years. Now, obviously, that the immigration policy has taken a big U-turn, you're not seeing those tailwinds of additional population coming into the United States needing housing, and as a result of that, you're seeing rents cool off quite a bit. So I don't think it's that surprising, but I do think it's one of the things that should give the Federal Reserve comfort, that they that inflationary pressures outside of some tariff-related pass-through are pretty benign at this point.
Given the fact that we're seeing no inflationary pressures to note that really are even beyond what people expected, and you are getting these announcements. You were talking about the Target announcements without naming them, laying off about 1,000 people and removing 800 jobs from their listings. We also saw GM announcing a round of job cuts this morning. I'm just wondering how much these are just anecdotes and typical versus something that really is a softening that is behind the disinflation as well as the concerns that the Fed has about the labor market.
Yeah, I mean, again, we think it's very symptomatic of how we see the economy that's ultimately adjusting to tariffs. I think the really big surprise this year coming into the year and thinking about tariffs is that you'd get some price level adjustment, and there's multiple ways that companies can adjust to this. And I think what we're learning is that they're not fully adjusting prices, and that they're trying to offset costs in other ways. And I think the fact that you're seeing this AI investment boom and some broadening out just in the diffusion of AI technology, companies are hoping to get some labor-saving cost benefits here. And investing in capital because of the tax, the new tax law, the One Big Beautiful Bill Act, gives you pretty big, tax incentives with upfront capital expensing. So I think companies are really just making this adjustment, more so through the labor market. And in terms of the Federal Reserve and their mandate, that just suggests that they have more room to start to adjust policy back towards neutral. If they do cut 2 more times this year, they would be, 3.5, which is kind of the upper end of the range of neutral estimates that they have. And so getting back there and making that adjustment, seems very reasonable to us, just given the information that's coming in.
Tiffany, when you say labor-saving cost benefits, should we all be expecting more layoffs then to be announced in 2026?
Well, I think the economy will need to go through an adjustment as a result of these transitions that we're seeing, whether it be the policy related transitions this year or this tech sort of tech transition that we're seeing. It does seem like AI is moving pretty quickly. I think it's still uncertain how much productivity gains we'll actually get and how that will save costs for companies. But I think we are starting to see the effects of that. I think you could start to see it at announcements, layoff announcements as well at some of the tech companies. It is displacing some workers. Now, I think what's harder to understand is, eventually it will also create new jobs, and how quickly will that happen, and what those new jobs will be is more difficult to forecast. But I think at least in the near term, you will see some labor-saving, displacement here, and the companies need that and are forced to try to get it because they have more tariff-related costs.
Stay with us. More Bloomberg surveillance coming up after this. President Donald Trump and Chinese President Xi Jinping are set to meet on Thursday in South Korea as the world's 2 largest economies look to ease trade sanctions. To extend the conversation, George Pollack of Signum joins us now for more. George, let's go through the issues. Rare earths, soybeans, and then we've got the issues around fentanyl. Of those 3, what's the hierarchy? What's the more difficult one to achieve?
I think for the president, the most difficult one to achieve is rare earths, because China understands that with rare earths, they have the U.S. in a disadvantageous position. And they remember when these tariffs were first implemented earlier this year, the car manufacturers came to the president and said, if you don't get the rare earths started, we're going to have to shut down production. And China knows that. And that's where the president's probably going to have to be most aggressive, but at the same time, understand China has the advantage.
Is China sending any signals that they're prepared to walk back what they have been doing when it comes to rare earths?
I think China's understanding of the rare earths issue is we haven't really done anything. And what we have done was more a response to your restrictions. And all we're doing is setting up a new licensing regimen. Rare earths are going to continue to come out, and you don't have to worry. So for China, we're happy with the status quo, but you decided to change things up, and you've decided to overreact and become more pugnacious.
Well, it's not just a new regime when it comes to rare earths. Any material that China exports that has an ounce of a trace of a rare earth needs to get a specific export license, which is why the Europeans are even considering using their anti-coercion tool. George, the fact that the Europeans are willing to go to the third rail, a tool they've never used in any negotiation, is that at the moment helping the United States into Thursday's meeting?
I think for the president, from Scott Bessent's viewpoint, it is helping the president give him a more global power and a more global idea that this can't go on. But at the same time, China is responding to this as, that's great that you're united, but we still have the advantage, and we don't understand why you're being so aggressive with us back and why you're deciding to play it so fast and loose.
So what's your base case then for Thursday? Is it just a continuing rolling truce?
Our base case is a continuing rolling truce where the U.S. and China understand the current situation with the president threatening increased tariffs and the continuing threat of this new licensing regime kind of rolls back to an extent where we get back to the Geneva or London understanding. But that doesn't mean it's a positive situation, because we're still going to be having these situations pop up every couple of weeks where either the president is frustrated or China is frustrated.
In the past few weeks, it seems like the U.S. has been trying to mend relations with a number of traditional allies and create closer ties, which is the reason why, in the wake of the announced meeting between Xi Jinping and President Trump, the new tensions with Canada are interesting. How do you sort of understand that in the bigger sphere of negotiations with China?
In terms of the tensions with Canada, the way we view this is Canada's right now between a rock and a hard place with the canola tariffs and EV tariffs they've placed on China, and they need to get that restarted. But at the same time, they need to deal with USMCA renegotiation. And we've always thought that USMCA is going to be an aggressive renegotiation from the president, and things like transshipment and rules of origin are going to come into play. And I think for the president, he's making clear to Canada, you're either with us, the United States, or you're with China. You can't get both.
This feels like a long game of leverage, and that's sort of been the big question between the U.S. and China, who has the leverage, and people argue on both sides. China having the leverage in rare earth minerals, maybe the U.S. having a bit of an edge when it comes to technology and just the dynamism in the U.S. economy. I just wonder how much you expect there to be some discussion of Russia and oil purchases, how much that's on the table versus just getting there and figuring out how to jawbone and kind of poke your elbows out to sort of have the same thing that we have right now.
I have no doubt that there's people in the White House who would like to discuss Russia, who would like to discuss oil, but I think the president's made clear his priorities are, among other things, fentanyl and soybeans, and I think that's where his focus is going to be. He is thinking short-term right now, and most likely his biggest short-term weakness is the farmers and is their inability to get assistance during the shutdown, and inability to get assistance because China, for the first time in 7 years in September, did not purchase a single soybean.
Can you tell me, George, your date on the calendar, what's circled, when you think the shutdown finishes?
I think we're still taking the place that this ends November 1st. For us, Senate Democrats understand that at November 1st, the healthcare enrollment opens up. Republican voters are going to see that their premiums increase. And for Democrats, that will be, while it'll be negative for voters, Democrats will be able to say, we wanted to fix this. Republicans were the one who said no.
So you're basically saying it ends November 1st because Democrats will line up for the continuing resolution, not because they struck a deal with Republicans on health care.
I think what will have to happen is Senator Schumer will have to walk a hard line to not go down, but to navigate his caucus and to allow either the retiring members or the more moderate members to vote for it. And then message saying, Democrats wanted to fix your health care. Democrats wanted you to avoid these premiums, but Republicans were the one who were saying no. And that will be the Democratic win will be, one, making healthcare an issue in the election. Two, Democrats being able to take the 80-20 side of an issue, the 80 side of an 80-20 issue, and Democrats being able to say Republicans are the ones to blame for what is happening with your premiums. And if you want to punish them, the best way to do that is to vote for us.
Stay with us. More Bloomberg surveillance coming up after this.
Stocks rising as markets await the latest read on inflation. John Stoltzfus of Oppenheimer writing, our intermediate and longer-term outlook for the US economy and the stock market remains decidedly, drumroll, bullish. John, the most bullish man on the street. Good to see you, sir. Good morning.
Good to see you, too. Thanks.
Let's get to some of these questions regarding inflation. How relevant is this morning's CPI data to today's market?
I think as long as it comes in line or close to in line, I think we'll be fine. If it's a drastic surprise, then, of course, to higher inflation, not so. And if it's also a much lower inflation, then people say we're in trouble. Is the Fed going to do 50 instead of 25? So it's any kind of action that can create bips for the traders you have to watch for. But we think it'll come in line with expectations, and we think that we'll get a cut tomorrow.
It's important to the extent that it shapes perceptions of Federal Reserve policy for next week and beyond. Does it shape perceptions of monetary policy for next week and beyond?
You know, I think we've said for a long time, we think the Fed is making down payments to Main Street and to Wall Street to give them an idea. Indeed, this monetary tightening policy period is is ending. It's just not ending as quick or as deep in terms of the cuts as both Main Street and Wall Street would like. But sometimes, you can't always get what you want, but you may find you get what you need,
Well, at this point, we're looking at earnings that are coming in better than expected. We're looking at a Fed that's going to look past any kind of CPI print and cut rates. And yet, yes, you're bullish. At the same time, you're talking about going up in quality. Mm-hmm. How do you pair those two ideas?
Well, I think you have to be realistic in that the market has genuinely shown that it's still a little bit nervous about small and mid caps. You have these days when we go risk off, where they don't go completely risk off in a traditional sense. They're not running out of the market, but all of a sudden you'll see the smalls and the mids will get a good day, versus the large caps. But when it comes down to it, people are concerned that perhaps the economy is weaker than perceived. We're in this blackout period without any data flow. So the thought really is it's you hug the large caps, but also the large cap stocks appear to be the most resilient when it comes to earnings. If you look at the earnings reports for the last earnings season, fourth quarter, first quarter, second quarter, and thus far third quarter, this looks good.
I love a good cliche on a Friday morning. What inning are we in here? Just because that is sort of a question, given that some people were talking about almost recession-like conditions earlier this year that have really revived, and a sort of reacceleration now into the beginning of next year.
Yeah, I'd say, we've thought for a long time, because of the change in the Federal Reserve's policy and the way it acts, how quick it acts, and how communicative it is, that essentially we've for a long period it's an extended mid-cycle. I like to say the economic cycle is as wide as the Amazon, and we mean the river. Okay, because it's been going on for a long time. How often have you heard from the bears we're late cycle, and that all of a sudden some of the most bearish in the past are saying we're actually coming to early cycle, and we're going back and forth. No, I think it's a big fat mid cycle, and it's because between the Federal Reserve policy, this Ben Bernanke legacy, as well as increased use of technology, creating greater efficiencies for both the consumer and business, and experience that's been garnered from all these things, whether it was the financial crisis, COVID, coming out of COVID, supply chain, trade wars, all this stuff. It's better than expected, and it's resilience. It's not, what was the old word they used to always, robust. Heck with robust. I will take resilience is what I like.
Well, you have a very long-term view.
Yep.
Short-term, though, there's a lot of policy uncertainty. What gives you the most angst?
Anne-Marie, it's what gives me the most angst is it has very little to do a lot of times with the market. It's just that the popularism of socialism and communism, which are failed ideologies, is rising in different places around the world. But I think related to what keeps me up at night is just I look at valuations, and as long as it's recognized that valuations are probably higher than historical standards would have us at this point, what we're believing is that people are investing more seriously than ever before, at least in the U.S., because they recognize Social Security will simply not be the same percentage of income in retirement. And people are worried that they might live too long. They don't want to lose their living standards. And so people go to equities, which historically have proven to be past performance, no guarantee of future results, but it's that equities have shown resilience in dealing with inflation, changes in the economy, changes in trend. It's good to own a good business.
This must be a generational thing. Who do you know that worries about living too long?
Well, but everybody.
I was going to say the same thing.
Do you know anyone?
Not at all.
If you look at it, though,
another year.
What they report in terms of investor behavior, it's cross-generational. So you still have, among the youth, you still have the desire to gamble in a bull market. It's the crypto, it's gold or silver.
I admire their bias to take risks, don't you?
Oh, absolutely. And you need that. It's good for liquidity. But they also are investing seriously on the other side of it, because they recognize that this Social Security, it's not that the politicians are going to eliminate it. That would be like an insurance company default. Sure. And those people would never get elected ever again to anything. But they recognize it just will not be the same support that it was, the same safety net.
I think America gets it. I think it's the Europeans that don't. The state is just not going to be there for them. Particularly our generation. in the coming decades, the state is not going to be there for them in the same way. Do you see the Europeans doing the same thing, a bias to invest, to participate in capitalism in this equity market?
I think from a cultural perspective, it's more difficult to move towards that. You've begun to see it just in terms of, if you look at elections in Europe, if you look at the way the market is beginning to respond to needs for development of technology to some extent, all of that shows that things are changing, but slower, because it has been, Europe and the UK have been steeped in socialistic practices that are big government, and that's expensive bureaucracy for the services provided. And there's a move that's beginning to happen. It's a pendulum that's slow, and politically, you have to avoid missing the signal for all the noise on a day-to-day basis. But the market is telling us this is actually manageable, and if anything, the alternative to cooler heads prevailing is much too awful to move towards.
Well, and this is really the key question. Are things better than expectations? What we saw this morning out of Europe were PMIs that actually came in better than expected, led by Germany. France is its own story. I'm just wondering, how much you can get excited there, or how much you really are staying focused on the United States based on the underperformance of the dollar so far this year, and based on the fact that you do have the base of people who very much are going to invest in preparation for reduced benefits down the line.
I would have to say we're still overweight U.S., but we say meaningful exposure to both developed international markets as well as emerging markets, because there you've got combination of valuation, demographics, where they are on the timeline of their financial history, in an attractive area. But we would have to say in the U.S., it's accountability, transparency, and governance for all the arguments that we have. We do have all kinds. You just see it in all the court action that happens in Washington. You've got people can still work things. There's a potential to work things out. The other thing is the dollar. When I look at it versus the Bloomberg dollar index, which is my favorite because it includes the emerging markets as well as the EFAs, what you've got is it was up last year. It was up about 7.98%, not to get too specific. And this year, it's down something like somewhere between 8 and 10, depending what day you look at it. It's down. Essentially, it's just giving back after a period of the dollar being so incredibly strong, because in an uncertain world, when things get really bad, all the world moves towards Papa, which looks like Uncle Sam.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.